Hello and welcome back to the second video and last video of this chapter, chapter 3. Here we'll be looking at preparing an income statement using the contribution margin format. So the contribution margin format differs from that of what we saw in our financial accounting course because while they both start with the sales revenue, we minus the variable costs such that we get the contribution margin. So it's interesting because as sales go up, so do variable costs, and that's because they share a driver. So by understanding what is the contribution margin, that is, we can also understand what is the additional amount of profit that we receive just from selling one additional unit. Yes, we still have our fixed costs to attend to, but this helps us break down our facts and figures such that we can make managerial decisions about our short-term operations. All right, so from there, we minus our fixed costs and we receive our net operating income. So again, let's compare and contrast. On the left, we have our traditional approach, cost organized by function, and then which is used by external reporting. This is what's required under our generally accepted accounting principles. This is our IFRS, our ASPE. Whereas used internally by management to make those short-term decisions, we want to understand how the cost behaviors act. So let's compare and contrast line by line. Both start with the total number of sales. That's units sold times revenue per unit. Then we're going to minus our cost of goods sold here. So our cost of goods sold are our product costs. Those are the items that came from our inventory, which we saw in our last video. If this is unclear, please go back and watch the chapter 2 videos on how cost of goods, that is items that go from our finished goods inventory, once sold, transfer the income statement and become cost of goods sold. So under the traditional approach, we have our sales less cost of goods sold equals our gross margin. Then we minus our operating expenses, our marketing, our selling, general, and admin, and we receive our net operating income. Conversely, we still have sales, so revenue per unit times the amount of units sold, minus our variable expenses. So here, we're going in and we're saying, okay, cost of goods sold, which one of you are variable, which one of you are fixed, and we're pulling out just the variable items. That means it's our direct materials, our direct labor, and our variable cost portion of our manufacturing overhead. So we're pulling all of that out. We only want to look at the variable expenses. Then we go to our operating expenses and we pull out just the variable expenses. We pull out if there was a commission sold per unit, we're going to pull that out because it's variable. And if there was a commission based to salary employees, boom, you stay fixed. Because no matter how many you sell, we're still giving you the same salary. So we pull all those out and you can see 70 plus 20 equals 90. 60 plus 30 equals 90. So we're not eliminating any expenses. We are simply categorizing these expenses by their cost profile, their cost behavior, and splitting them into variable or fixed expenses. So we have our sales less our variable costs equals 40,000, which is our contribution margin, minus our fixed expenses gives us net operating income of 10,000. So same, but different. Let's look at an example. All right, so we have our example right here where we have Stewart Manufacturing producing metal frames. The company's income statement for the past 2 years are as follows, last year and this year. We are told to please compute the company's contribution margin, knowing that the fixed costs per year are 150,000. All right, so let us start by making our income statement last year and this year. And friendly reminder, we are making a contribution margin income statement, and we are given a traditional income statement here. So right off the bat, what I'm going to do is, well, there's no marks for pretty. I definitely like bolding things. Just makes me happy. Okay. And I'm going to set up the format first, and then I'm going to fill it in with the information that I have available. start with sales. I'm going to go less variable cost, or VC. And then I'm given my contribution margin, my CM. And while this is a contribution margin style income statement, that is not where I stop. I do not stop at contribution margin. What do I have next? Fixed costs. Less fixed costs, or FC. And then from there, what's the last line that I have in my contribution margin statement? Well, it's the same as my traditional one, and that's net income. Net income. Okay. So I know that my sales start off the same. So 50,000 last year and 70,000 this year. Then I'm not sure what this is yet, because it's some in the cost of goods sold, some of them in the operating expenses. Don't know what my contribution margin is, but I know what my fixed costs are. So my, oh, sorry, if you're like, Sam, our sales, that's the units. Sorry, you're right. So it's 800,000, apologies, and 1,120,000. Perfect. So if you're screaming at home at me, perfect, love that. And I just want to point out, I got that from here, the sales right below the units sold, the one with the numbers on. Okay. So I don't know my variable costs yet. I'm going to have to compute them. I don't know my contribution margin because I don't know my variable costs yet. I know my fixed cost though, and that is 150,000 per year. Okay. So this makes sense. It's a manufacturing company. They produce metal picture frames that my fixed costs are going to be relatively low to the amount of sales and to the amount of total costs. Because it's a manufacturing company, and because we were told in an earlier slide in Learning Objective 1 of Chapter 3 that manufacturing companies tend to have less fixed costs and more variable costs. Okay, and I know that my net income is going to be the same. It's 100,000 and 220,000. And the reason is I'm not creating or eliminating costs. I'm simply organizing cost of goods sold and operating expenses according to their cost behavior. Are they variable or are they fixed costs? Okay. Okay, so what am I going to do? Well, I can do a couple different ways. I can determine, I'm going to go with I'm going to look at last year, and I'm going to look at my cost of goods sold, and I'm going to look at my OPEX, my operating expenses. And so I know that I had 550, grabbing that from the traditional income statement, and I have my operating expenses of 150,000. And so then I know my total expenses for the year were 700,000. And I'm going to just put a little line there. Great. So I know my total expenses are 700,000. I know that my fixed and my variable need to equal that. Well, I know my fixed, so less fixed costs, or FC, and that is going to be 150,000. So I'll just link it above. And so then I know that my total variable costs are going to be the difference between total expenses and fixed costs. $550,000. Awesome. So now I'm going to put in my variable costs here. Now I know that my sales less my variable cost equals my contribution margin of 250,000. And then my contribution margin less my fixed costs equal 100,000. So we balance here and we are good. All right, so I'm going to encourage you to pause this video and to complete this year's contribution margin. Feel free to use this as a base, and then feel free to calculate this. It doesn't really matter what you use as plus or minuses, as long as conceptually you understand we have sales, we less variable costs, we have contribution margin. Then from that, we have our contribution margin less fixed costs equal our net income. So however, if it's positive and then you just, you minus them in the cell, or it's negative and you add them, however you want to do it, I'm more concerned with, do you get to this net income and do you understand why? So please pause the video and I'll see you back in just a moment. Welcome back. All right, let's go through and do this again with this year's items. Just so you know, please, we would never say this year and last year. We would have like the actual years in there, in which case I'm recording this on January 15th, 2025. So this year would likely be like probably 2024 because that's the most recent data that I have. And then the last year would be 2023. Okay, so cost of goods sold, that's 710. And then I have operating expenses of 190. And this equals total expenses of 900,000 for the year. Great. And then I am told that we have 850,000 in our total fixed costs. They didn't, they just said 150,000. So that maybe it's like a lease or something, an office lease. Great. Manufacturing lease. Fabulous. It's in here. Maybe some salaries. So in order to get my total variable costs, I have my total costs less my fixed costs, and I have $750,000 in here. All right, so now I take my fixed costs and my variable costs and I'll link them below. And so then I have my sales less my variable costs gives me my contribution margin of 370,000. I math this out, 370 minus 150 equals 220. 220 matches, and I have just turned my traditional income statement into a contribution margin statement. Apologies, correction. We have just turned our traditional income statement into a contribution margin income statement. Fabulous. And again, if you didn't get this on the first go around, feel free to rewatch this video and do some additional practice problems, post to the discussion board, and yeah, I'm sure before long you will feel more and more confident with the contribution margin statement. All right, last slide. As we saw in chapter 2 and as we built on here, there are 3 major classifications of costs: variable, fixed, and mixed. The contribution format income statement classify these costs by variable and fixed costs, behavior rather than by functional area, such that we can make managerial decisions. All right, so this is it for this chapter. In theory, chapter 2 and chapter 3 could have been combined in 1 week. Perhaps they could have been even combined in 1 chapter if that's what the publisher had chosen. However, we chose to have some larger weeks and some moderate weeks. Or lighter weeks, because that's ebbs and flows of real life, that's ebbs and flows of classes, that's ebbs and flows of this course. So please do take, quote, that extra time and consider really beefing up your understanding, going back to the practice problems, because your first term test is going to be on chapters 1, 2, and 3, with the sample term test available 1 week before its deadline. Please refer to the syllabus for your deadline. It opens on a Monday and closes on a Friday, and you have 60 minutes to complete it within that time frame. It is not meant to be open book, so that is why there is a 60-minute time frame. However, we do understand that in this hybrid course, it is good to have a mix of examinables. It's good to have a mix of kind of evaluations, because you do have a mix of deliverables, right? You have and a mix of how you're receiving the information. You're receiving the information some online via these asynchronous mini videos, via the pre-work. You're also receiving a mix of these offline, in person, using the tutorials and using our quizzes. So as such, it is appropriate, we feel, to have some online exam evaluations. So while it isn't designed to be open book, because honestly, I don't think you'll have enough time to kind of like look up the answer and do the thing, you will have access to your notes. We won't prohibit you from using your notes, won't prohibit you from using your book in the term test. However, I just really want to warn you that in the past, on similar tests, students that do use their book have said, and who have relied heavily on their notes, have said that they found that they didn't have enough time. However, students who said that they didn't rely on their book and that they studied and prepared for the term tests that were online said that they had a sufficient amount of time. They said it was tight, but it was doable. So just give you a heads up. That is what is next as far as the major deliverables. Check your syllabus. And I want to thank you so much for your great attention throughout this week and previous weeks. I appreciate your meeting with me during office hours. I appreciate you coming to tutorials, watching these videos, and really engaging in this lecture material, this course material in general. So I hope you have a wonderful day, a wonderful week, and we'll talk soon.